Crocs Inc. ticker symbol Crocs is currently trading at $109 a share, up 3% on the day. But if we look at the stock over the last year, it is down around 25% from its prior highs, and has had a very volatile time year to date. Bottom of it was $88 a share, 12th of February. It's up about 22% since then. So is this a good buying opportunity? Can it get back to its prior 2024 highs? What we're going to be doing is quickly going through their most recent earnings and then taking it to my automated stock valuation spreadsheet to see if Crocs would buy or sell using the discounted free cash flow model, comparable company model, dividend discount model. Well, we won't be using that because Crocs does not pay a dividend, and the Ben Grimm formula for intrinsic value. So firstly, let me just put in the ticker CROX Crocs, and this will load up all the latest company financial data so we can have a deeper look. If we look from, well, we'll go to the max chart here. This stock was, I can't even get this, $20, $10 a share at the bottom of the pandemic. I mean, if we look over the last 5 years, this has been an absolute will beat at 640%, even with these massive swings. Obviously down from its all-time highs at 180, but is still beating the market over the last 5 years, but over the last year down 25%. So we have the sheet here. $109 a share, market cap of 6.1 billion, a PE ratio of 6.87, which is way lower than the market average, which is currently at 27.99. So this is actually dropping as well, but under 7 is crazy, one of the lowest I've seen. Earnings per share, $15.88, and a beta of 1.84, meaning it's a lot more volatile than the market. And recently it did get hammered, as we saw in February when everything was down. This got hit more than others. Target price, analysts have it about 128, so massively undervalued according to analysts. So we have the revenues here. Let's just have a jump in. We will not be looking at the trailing 12 months because despite what this says, this is actually the full year, so ignore this. He will just look at the revenues here. 4.1 billion, up from the prior years, so they've had big growth in 2020 and continued to sustain that. Also, if we do have a look here, we have the full year earnings. This is in thousands. Normally it's in, but we'll compare it here so you can see it's gone up. Gone down slightly for. Sorry, where am I looking? Revenues. Yeah. So this is the 3 months ended. That is the 12 months ended. Sorry, my mistake. 9.6 to 9.9, and then on the year 3.9 to 4.1, which is obviously what we saw on the other sheet there. But if we do scroll down, we see how it is split up. So we have. Year ended 23, 24, and 3 months ended, and this is split between the North America wholesale and direct to consumer. You can see if we just look at the year dates here, wholesale is down slightly, but direct to consumer is up, which brings the total of North America up. International, different story, both up. Wholesale up about 10%, and direct to consumer up over 15%. And then we can see here, this is everything here, everything is up. Hey dude, this was a lot of the reasons why people are not interested in this stock. You can see it is down full year, but that the actual Crocs proper brand, the Crocs brand business, is doing very well. Net income, are they able to generate more profit? Yes, they are. 0.95 billion. Free cash flow, are they free cash flow positive? Yes, they are. 0.92 billion. If we have a look at cash flow, operating cash flow versus capex, you can see operating cash flow is increasing, capex is down, but free cash flow is increasing as well. Shares outstanding, buying back the shares, that's what we like to see. So let's have a look at the discounted free cash flow model. This is a way of valuing stocks, looking at the future free cash flows, discount them to today's value, and currently it gives us a price of $360 a share. So that seems very high, but let's have a deeper look. I mean, with the free cash flow payout ratio of, free cash flow ratio of 7.5, and the average of the last few years being 12, I can see this being a good buy in terms of discounted free cash flow, but this price does seem a little high. We'll have a little look. So revenues, we're expecting 4.8 and 5.7 billion in the coming years. Analysts are expecting a lot less. We'll bring this down, 4.2, 4.3. So they're expecting quite slow. So what was that, about 5% growth, if that? Still $200 a share. Net income margins, we'll take an average of these last few years. That 50% seems to be a bit of an outlier. That brings us to 23.74%, $190 a share. And we'll have a look at the net income to free cash flow. I mean, you can see it's all over the place. Even if we take an average of these last ones, it actually does bring it up to 85, and that still puts it at 210. So looks like discounted free cash flow really likes the stock. If you're interested in the sheet, please check out my Patreon. It's a $4 tier. This gives you full access to the sheet. You can do as many stock analysis as you please. But I would still like you to watch these videos. Anyway, Ben Graham formula for intrinsic value. This looks at earnings per share, PE of a non-growth company, the AAA bond yield, corporate bond yield. Let's see if this has changed. I believe it has. Oh, it's gone up. Oh no, 5.29. Oh no, it's gone down. Gone down. That's even better. So this means Ben Graham will like these stocks a little bit more. Ben Graham has hated stocks recently due to the high bond yields. Where is the growth? Where is the growth? 7%. So underperforming the S&P 500 is what it's expecting, but still $204 a share. Interestingly, very close to what the discounted free cash flow model has it. So they both have it about $200 a share, currently at 109. So a massive buying opportunity. Finally, we'll have a look at the comparable company model. This is the way of valuing stocks, looking at their competitors. We'll be looking at revenue growth rates, EBITDA, net income, profit margins, price to sales, price to book PEG, EV to revenue, EV to EBITDA, PE, and 4P. Now, don't be worried by these errors. It's just because I had to do some dev work on this sheet, and I temporarily broke it, but I have fixed it again. So what we'll do is we'll look at one of their, I'd say, core competitors, very popular stock at the minute, Nike, ticker symbol NKE. We'll look at UA, which is Under Armour, which is more of apparel, footwear and accessories, but Nike apparel as well, but obviously athletic footwear is the main bread and butter. And we'll do a couple. First we'll do Deck, which is Decker's Outdoor Operation, UGA and Hooker, casual and performance wear. Unfortunately, Under Armour do not have a PE, so we can't use them. But you can see, actually, we'll just run through quickly here. Revenue, smallest, highest growth rates, bottom EBITDA, more profitable than the other ones. Only Nike's more profitable, so that's good. Massive margins, blows everything else out the water, apart from Deckers. Actually, Deckers is quite close. Price to sales, you want this under the market average, which is around about 2.5. They're all under, apart from Deckers, which is good. Price to book, market average is around about 4.8. Under it. PEG, I wouldn't trust that PEG. You want this under 1, I'm guessing there's a problem with that. So we will not look at that. EV to revenue, towards the bottom. EV to EBITDA lowest. PE the lowest. 4P the lowest. Now, I'll just take an average of these three. $275 a share. Now this is because Deckers is not Under Armour is not profitable. So let's do Skechers, SKX, and see what this brings up. And $190 a share. Once again, lower than all of these. EV to revenue is probably the one where it's the closest, but still puts it at 190. So Ben Graham has it at about 200. Comparable company model has it at about 200. And the discounted free cash flow model, not this one. This is the trailing 12 months. This is the full quarter one. Has it at about 200. So all of the models do have it as a buy. Quite interesting. Right, guys, thanks for watching. Please give a like on the video if you enjoyed. Subscribe if you're not already. Check out my Patreon, and I'll catch you guys next time.